What is a total portfolio approach and what does it mean for you and your investments? We'll talk about that this week.
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
One of the things that we talk about often in Make Better Wealth Decisions is portfolio management in general and the more conventional way of looking at things in terms of finding ways to match risk and return and to build portfolios using traditional vehicles, stocks, bonds, exchange traded funds, offering memorandum products, specialty products, in ways that can get you a risk-adjusted return that is hopefully going to get you to wherever it is you want to go with your investment objectives. For most people, that means reaching retirement, but it can mean other things as well if you're trying to do things in the short term to buy a house or to maybe put your kids through a great education program. One of the things that has come to light in the past 10 or 20 years is that the more conventional way of looking at things using standard publicly traded securities, stocks, bonds, and so forth is great as far as it goes, but it's incomplete. There's been a realization that the so-called pension approach, the approach of using other assets, alternative assets, infrastructure, real estate, things that have a long short mandate, things that are unconventional in terms of toll roads or music royalties or film financing or any number of different things that might not always move the way conventional stocks and bonds move, which is to say they are oftentimes non-correlated or weakly correlated. If you can find ways to incorporate those sorts of investment theses and products into your portfolio, judiciously, of course, and bearing in mind that they oftentimes have a cost and oftentimes are less liquid than standard products, you still might be able to find a way to increase your return for the same amount of risk or reduce your risk for the same amount of return by putting more than you otherwise might have thought into these sorts of alternatives. To put it in perspective, the Canada Pension Plan is one of the most highly respected pension plans on the planet. It has been doing a good job of getting more or less benchmark returns without using conventional benchmarks. Now, there are those people who would say that you could actually get a better return on their standard products, Canadian stocks, Canadian bonds, US stocks and bonds, international stocks and bonds, by just using passive management. And I tend to think that's the case as well. However, there's another substantial pool of capital that makes up a good portion of the Canada Pension Plan that is almost never found in retail portfolios when you look at them. And these are the sorts of things I was talking about previously: infrastructure, roads, desalination plants. As you may know, we once had a major pension plan here in Ontario that owned a major hockey team. There are different things that not all retail investors can get a chance to invest in, but that nonetheless, pension plans, given the opportunity, will say there are dozens of other ways that we can make money. And now that the world is expanding and the universe of investment opportunities, the opportunity set of things that you can invest in as a retail investor has expanded, I would say that it behooves you to consider putting these other funkier things, less conventional things into your portfolio, because although they sometimes get higher returns, they oftentimes are they're very stable and they seldom have the highs and lows that you get when you are investing in publicly traded securities in particular. So what you can do is if you can get, say, pick a number, 6.25% rate of return, you can get a 6.25% rate of return using let's say a 70-30 mix of standard stocks and bonds, or if you can use, let's say, 50% stocks and 20% bonds and put 30% of your portfolio into other things that have a steady, stable cash flow and risk return profile, you might very well be able to get that same 6.25% rate of return, give or take, with less risk by virtue of putting 30% of your money into these things that get a similar aggregate return but that don't go up and down when stocks go up and down. This is a major development in the way portfolios have been thought about and constructed that has been gaining traction for about a generation now, and it's been fairly well accepted in the pension world. It's just that it's only recently in the 20 teens and the 2020s that we're actually getting to the point where these sorts of more off the wall type alternative investments, things that are, I say off the wall because they're not conventional, but they're not weird either. They're just standard things that have been around in many cases for decades or centuries, even that just weren't available to retail investors until very recently. If you can find ways to get these sorts of things into your portfolio, it can oftentimes lead to a better risk adjusted return, which is just another way of saying making a better wealth decision. If you can find ways to improve your return or to lower your risk, or maybe even do a little bit of both by adding things into your portfolio that weren't there before, and these are generally referred to as alternative investments, you should consider doing it and do it in a prudent manner. Obviously, I'm not talking about putting 75 or 80% of your money into alternatives, but I would say anywhere from 10 to 50%, depending on your risk profile, could be put into alternatives and justified as being something that could help move the efficient frontier to the point where you're getting either higher returns or lower risk or a bit of both. Something to think about as you try to make better wealth decisions.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdeguy@designedsecurities.ca.